Welcome to Tradespoon. My name is Vlad Karpel and I'm the CEO and founder of Tradespoon. And today I'd like to talk about option call. For those of you who are new to options and never learned what a concept of call is, I want to make a quick introduction to call. So let's take a look. What is an option call? A binary option is a financial contract that gives the trader the right but not the obligation to buy or sell an underlying asset at a specific price on or before a certain date. Option, just like stocks and bonds, is a security, an asset with an associated value. Options are also binding contracts with clearly defined terms and properties. So the way I'd like to think of a specific example is if you want to buy a house, an average house in the United States costs $250,000, but you don't want to pay for the house right now. You want to postpone this event for 6 months. Well, you can go to your landlord, if you want to buy a house from your landlord, and say, listen, I'm going to rent for 6 months and pay you rent, and in 6 months I want to buy the house for $250,000, which is a fair market value today. So this is an example of a call where you postponing the purchase of underlying asset and you paying a contract to a holder of underlying asset, such as a rent. So option call, think of it as a rent. And there are two types of options. One is calls and one is puts. Let's just concentrate on the calls for now. A call option gives the holder the right to buy an asset at a specific price with a specific period of time. And you will see, as you see it on your graph, as time goes by, between now and 6 months, in the case of the house, your profit will fluctuate with the same way the underlying asset price fluctuates in price. Very important if you're new to options trading, and this is the first time you heard about call or you want to learn about calls, these are the most important terms or attributes of an option that you need to keep in mind and learn before you commit any real capital into trading. First is a strike price selection. You can see on the right hand side that this is a profit loss graph for the option. You have a limited loss at $200 and you have unlimited gain as the stock reaches the $40 level on your chart, and then going into the $50 you have unlimited gain. So it's very important to select a strike based on predictive analytics or based on the technical analysis. It's also important to select an expiration month. The stock has to move from $40 to $50, as you see it on your chart, by a specified time. If you're not correct on the time, then you will not benefit from the upward movement in the underlying asset. You need to be comfortable with the option price. We talked about in other videos how important it is to know what implied volatility is, how much uncertainty in the market is, and how does it affect the underlying option price. Options are derivatives, right? Just like your insurance, you know that your insurance can be more expensive or less expensive at different times. If you live in a hurricane, if there's a hurricane season, and let's say you live in Miami, you know that the price of the insurance goes up during hurricane season, but it goes down when nobody expects the hurricane. So same thing, option price goes up when there's uncertainty in the market, and option price goes down when there's less uncertainty in the market. You need to learn implied volatility, you need to follow that concept. Assignments and expiration. This is where you can actually lose a lot of money. If you get assigned on a stock, especially if your stock is in the money, you get assignment, you might sustain a lot of losses, potentially unlimited losses. So you have to be careful, make sure you either close your option contracts prior to expiration, or pay attention when your broker-dealer assigns you on the option, meaning that you're either going to have a short stock or a long stock, you got to close that position as soon as possible. Expiration is very important. This is where you want to close the stock, because if you don't, options tend to move very similar to stock the closer you get to the expiration. And also in the money, out of the money, or at the money, what does that mean? And why do you buy options that are in the money or at the money? And why do you sell options out of the money? If you don't understand those characteristics and attributes, this is something you want to look it up and make sure you're comfortable with these concepts. Key points to remember: time range selection. You got to be correct on the time. If the stock doesn't move from $42 to $50 at the time that you selected, your options expire worthless, right? Just like you buy an insurance in the house, if nothing happens on your house, which is good in case of insurance, then, well, you just lose the premium that you're paying to insurance company. That's why actually insurance companies are so profitable, because most of the time, from statistical point of view, nothing happens to your house. So slowly insurance companies just collecting the premium from month to month. In order to be a successful trader, you have to have directional bias. If you buy on a call, you have an upward directional bias. You want the stock to go from $40 to $50, and only then you're going to start making money. So you have to have a bias. You don't have to know exactly whether the stock is going to be at $50 or $55, but you have to have a directional bias. Again, volatility, high uncertainty, high prices you have to pay for options. Leverage. On average, retail account in the United States is $10,000. If you want to buy stocks like Priceline that trades at $1,500, well, you don't have enough capital. Options allow you to leverage your capital. And always keep in mind two things that will make you a more experienced trader and more confident trader. Once you understand the concept of risk versus probability of success, that the higher the probability of success, meaning higher risk. As you get more experience, you will trade in a way that you have higher probability of success, but you have to be aggressive in defending your positions in case stock goes against you. Well, hopefully you learned a little bit about calls today and you're intrigued enough to learn more. If you want to learn more, please visit Tradespoon.com and look at our upcoming webinars, and also follow us on social media. Thank you very much.